How to invest $1,000 as a beginner, step by step. Are you ready to transform your financial future? Many people believe you need a fortune to start investing, but that simply isn't true. You can begin building real wealth with as little as $1,000. Stop letting your hard-earned money sit idle, losing value to inflation every single day. This guide will show you exactly how to invest $1,000. Even if you've never invested a single penny before, we'll break down the process into clear, actionable steps, making investing accessible for everyone. Do well to subscribe, like, and share if you have not already done so, and smash the bell notification so you don't have to miss out on any updates. Now, investing isn't just for the wealthy. It's a powerful tool for everyone to build financial security and achieve their goals. The biggest enemy to your savings is inflation, which constantly erodes your money's purchasing power over time. What $1,000 buys today will buy less in the future. Investing allows your money to work for you, growing over time through the magic of compounding. Compounding means your earnings generate their own earnings, creating an exponential growth effect. Starting with $1,000, even small returns can add up significantly over years and decades. It's about planting a small seed today that can grow into a mighty tree tomorrow. Your first essential step is to open a brokerage account. Think of a brokerage account as your personal gateway to the investment world. Much like a bank account is your gateway to saving and spending. This is where you will hold your investments. For beginners, it's crucial to choose a brokerage that is user-friendly, offers low fees, and provides access to a wide range of investment options. Many reputable online brokerages cater specifically to new investors. Look for platforms known for their intuitive interfaces and educational resources. Popular choices include Fidelity, Charles Schwab, Vanguard, and even newer platforms like Robinhood or M1 Finance. Each has its own strengths, but they all allow you to buy and sell investments. Most offer commission-free trading for stocks and ETFs, which is a huge benefit for beginners. The process of opening an account is straightforward and can often be completed online in minutes. You'll typically need to provide some personal information, such as your name, address, social security number, and employment details. You'll also link your bank account to easily transfer funds. Ensure you choose a taxable brokerage account for this initial $1,000 investment, as retirement accounts like IRAs have specific contribution limits and rules. With your brokerage account ready, the next critical decision is what to invest in. For beginners, the most effective and safest strategy is diversification. Diversification means spreading your investments across various assets to reduce risk. Putting all your money into one company's stock is incredibly risky, as that company's performance directly dictates your entire investment's fate. Instead, we highly recommend exchange-traded funds, or ETFs, for your first $1,000. ETFs are baskets of various investments, such as stocks or bonds, that trade on stock exchanges like individual stocks. When you buy one share of an ETF, you are instantly diversified across potentially hundreds or even thousands of underlying companies. This provides broad market exposure and significantly lowers your risk compared to picking individual stocks. ETFs are ideal for beginners because they offer simplicity, instant diversification, and typically have very low expense ratios. An expense ratio is an annual fee charged by the fund manager, expressed as a percentage of your investment. Lower expense ratios mean more of your money stays invested and grows for you. For your first $1,000, focusing on broad market ETFs is an excellent starting point. These funds aim to track the performance of an entire market index, such as the S&P 500. This strategy is often referred to as passive investing, as it doesn't involve constantly buying and selling based on market fluctuations. It's a proven, long-term approach that has historically delivered solid returns. Now that you understand the power of ETFs, let's talk about how to choose the right ones for your $1,000. For beginners, an S&P 500 ETF is often the best recommendation. The S&P 500 is an index that tracks the performance of 500 of the largest publicly traded companies in the United States. Investing in an S&P 500 ETF means you own a tiny piece of these economic powerhouses, providing broad exposure to the U.S. stock market. When researching ETFs, pay close attention to their expense ratios. Aim for funds with expense ratios below 0.10% if possible. For example, popular S and AMP 500 ETFs like VOO, SPY, and IVV all have very low expense ratios, typically around 0.03% to 0.09%. This means for every $1,000 invested, you're paying less than $1 in annual fees. You can find detailed information about any ETF on your brokerage platform or financial websites like Morningstar or Yahoo Finance. Look at the fund's holdings to understand what companies it invests in. While past performance doesn't guarantee future results, reviewing historical returns can give you a sense of the fund's long-term trajectory. Remember, the goal here is broad market exposure, not trying to pick the next hot sector. Consider starting with a single S&M P500 ETF to keep things simple. As you gain more experience and potentially invest more money, you might explore other diversified ETFs, such as a total U.S. stock market ETF, an international stock market ETF, or even a bond ETF for further diversification. However, for your initial $1,000, simplicity and broad market exposure are key. With your brokerage account funded and your chosen ETF identified, it's time to make your first investment. This is an exciting moment, so let's walk through the process of placing an order. On your brokerage platform, you'll typically find a search bar or a trade section. Enter the ticker symbol of the ETF you've chosen. For an S and AMP P500 ETF, this might be VOO, SPY, or IVV. Once you've found the correct fund, you'll see its current price and other relevant information. You'll then need to specify the type of order you want to place. For beginners, a market order is usually the simplest option. A market order instructs your brokerage to buy the ETF shares immediately at the best available price. Next, you'll enter the amount you wish to invest. Since you have $1,000, you'll input that figure. Many modern brokerages offer fractional share investing, which is incredibly beneficial for beginners. This means you can invest a specific dollar amount, like $1,000, even if it doesn't perfectly buy a whole number of shares. The brokerage will then buy a fraction of a share for you, ensuring your entire $1,000 is put to work. Before confirming, always review your order details carefully. Double-check the ticker symbol, the amount, and the order type. Once you're confident, click the Place Order or Buy button. Congratulations, you've just made your first investment. The shares will typically settle in your account within a few business days. Making your first investment is a significant milestone, but the journey doesn't end there. To truly succeed, you must adopt a long-term mindset. Investing is not about getting rich quick. It's about consistent, disciplined growth over many years, even decades. The stock market will experience ups and downs, known as volatility. Do not panic when the market dips. Short-term market fluctuations are normal and expected. Resist the urge to sell your investments during downturns. Historically, the market has always recovered and reached new highs over the long run. Patience is one of the most valuable virtues in investing. Focus on your long-term goals, whether it's retirement, a down payment on a house, or funding your education. Another powerful strategy for long-term growth is to reinvest your dividends. Many ETFs, especially those tracking broad market indexes, pay out dividends to their shareholders. Dividends are a portion of the profits that companies distribute to their investors. Instead of taking these dividends as cash, instruct your brokerage to automatically reinvest them. Reinvesting dividends means those small payouts are used to buy more shares or fractional shares of the same ETF. This creates a compounding effect, as those newly purchased shares will then generate their own dividends, which are also reinvested. This snowball effect significantly accelerates your wealth accumulation over time, allowing your money to work harder for you without any additional effort on your part. Once your investment is made, it's important to monitor your portfolio periodically, but avoid obsessing over daily fluctuations. Checking your portfolio every day can lead to emotional decisions based on short-term noise. Instead, aim to check in once a month or once a quarter. This allows you to see the broader trends and ensures you're not reacting impulsively to minor market movements. Your brokerage account will provide statements and online tools to track your investment's performance. Focus on the overall growth of your $1,000 over months and years, rather than daily percentage changes. Remember, the goal is long-term wealth building, not day trading. Beyond monitoring, commit to continuous learning. The world of personal finance and investing is vast, and there's always more to discover. Read reputable financial books, watch educational videos from trusted sources, and follow financial news to stay informed. Understanding economic principles, different investment vehicles, and risk management will empower you to make more informed decisions as your investment journey progresses. Start small, but think big. Your initial $1,000 investment is just the beginning. As you continue to save and learn, you can gradually increase your contributions, explore new investment opportunities, and refine your strategy. The most important thing is to start today and build that foundation. Let's quickly recap the essential steps to investing your first $1,000. First, open a brokerage account with a reputable, low-fee platforms. Second, choose a diversified investment strategy, with broad market ETFs being the ideal starting point for beginners. Third, research and select an ETF, focusing on low expense ratios and broad market exposure like an S&P 500 fund. Fourth, confidently place your order, utilizing fractional shares if available to invest your full $1,000. Fifth, cultivate a long-term mindset. Resist panic selling during market downturns, and always reinvest your dividends to harness the power of compounding. Finally, monitor your portfolio periodically and commit to continuous learning to grow your financial knowledge. Your financial future begins now. Don't let another day pass with your money sitting idle. Take the first step by opening a brokerage account today. You'll find links to recommended platforms in the description below to help you get started. If this guide has empowered you, please give this video a like, share it with someone who needs to hear this message, and subscribe to our channel for more practical financial tips. Your journey to financial independence starts with that first $1,000. Let's build wealth together.